If you've been investing for a while, chances are you've heard of SCHD, the Charles Schwab Dividend Equity ETF. It's the golden child of dividend investors. But here's the thing. What if I told you that there's another ETF quietly outperforming SCHD in key areas? One that could actually give you better total returns, higher growth potential, and still keep that steady stream of dividends. This isn't about hating on SCHD. SCHD is incredible. It's reliable, and it's one of the most investor-friendly ETFs. But every once in a while, something new emerges, something built for the next decade, not the last one. SCHD's strategy is clear. It focuses on quality companies with a history of paying dividends for at least 10 years. Companies like Pepsi, Merck, and Coca-Cola, the blue-chip backbone of American capitalism. You get stability and consistent returns. But as good as SCHD is, it has one major limitation. It leans heavily on sectors like industrials, healthcare, and consumer staples. That's where this new ETF comes in. A dividend ETF that bridges two worlds. Imagine holding an ETF that gives you exposure to companies like Microsoft and Nvidia. The biggest challenge for dividend investors in 2025 is balance. You want yield, but you don't want to sacrifice growth. Funds like JEPI or Devo started to change the game. They introduced active management into the dividend ETF space. But this new contender takes it further. This ETF hits the perfect middle ground between SCHD's growth potential and JEPI's juicy yield. It's built for investors who seek to enhance their dividends. SCHD offers a stable dividend yield around 3.5%. Respectable and predictable. But this new ETF is boasting closer to 5% in yield. That's a full 1.5 percentage points more in passive income. Over 10 years, this difference can compound into tens of thousands. SCHD has averaged around 11% annually over the last decade, while this ETF has been closer to 12 or even 13% in back-tested performance. When you add the compounding effect of reinvested dividends, you start to see real wealth acceleration. But here's what makes this fund special. It's built to adapt. SCHD rebalances once a year based on its index. In the real world, things move fast. Inflation, interest rate hikes, geopolitical shifts. You can't afford to wait 12 months to react. This ETF uses an active or semi-active strategy that allows it to shift weightings between sectors dynamically. That level of flexibility makes it more resilient in volatile markets, which is something SCHD sometimes struggles with. Now, some people might say, but active management means higher fees. And yeah, that's true. SCHD's expense ratio is famously low at 0.06%. But even if this ETF charges 0.35% or 0.4%, the trade-off in performance more than compensates. Think of it like this. Would you pay 30 basis points more for 2% higher returns? Absolutely. SCHD has about 100 holdings, very concentrated for an ETF. That's great for conviction, but risky if one sector tanks. This fund spreads its exposure more broadly across U.S. and international equities, giving you a global dividend portfolio. Many investors are chasing yield, flocking to REITs, BDCs, or covered call funds, but many lose value over time. This ETF sustains both principal and payout, meaning your portfolio doesn't bleed value while you collect dividends. If you invest $100,000 into SCHD, you get $3,500 a year in dividends. This new ETF pays $5,000. Over 10 years, SCHD might grow your investment to $285,000. The new ETF? Closer to $330,000. When your ETF pays higher income, it feels good. You're more likely to stay invested and less tempted to panic sell during dips. Let's talk taxes. Holding SCHD's qualified dividends in a taxable account may lead to Uncle Sam's share. This new ETF might offer a more tax-efficient yield through option premiums or capital gains deferral strategies. An underrated advantage is liquidity. This ETF gains traction fast, meaning tighter spreads and easier trading. Traded on major exchanges, this ETF fits into any brokerage or retirement account without hassle. This ETF is for the investor who loves SCHD's foundation but wants more excitement and upside. It's for those building a dividend portfolio to live off dividends sooner, believing in income that grows with innovation. No ETF is perfect. SCHD, JEPI, and this one all have their flaws. Growth slows, payouts fluctuate, and market sentiment shifts. The key is consistency and a strategy that performs across cycles. This ETF excels in that area. In 2025, with inflation and high interest rates, you need ETFs that grow and pay at the same time. This fund's portfolio has well-known top holdings, but focuses on future aristocrats with growth momentum. Investors who master this balance will come out ahead. SCHD will still be strong, but this ETF could quietly become the new benchmark. By the time everyone realizes it, it could already be too late to act. Comparing these ETFs reveals subtle differences that can massively impact returns over time. SCHD boasts a 5-year dividend growth rate around 12%, but the new ETF shows similar, even faster growth. Fund inflows into this ETF have skyrocketed, indicating a demand for income that doesn't stagnate. The companies that adapt fastest to the evolving economy will continue to expand profits and dividends. During recent corrections, this ETF showed lower volatility than the S&P 500 and even SCHD in certain quarters. Its structure includes a balance between defensive and growth-oriented stocks. This built-in diversification cushions the blow. In investing, mindset is everything. Many fail because they abandon strategies too early, panicking during dips. Having consistent dividend income changes your behavior. You stop obsessing over day-to-day price movements. This ETF, with its higher yield and stable distribution structure, reinforces a winning mindset. With SCHD, most investors hold it for quarterly distributions. This ETF pays monthly or more frequently, compounding your returns faster. Monthly compounding might seem trivial, but it's like getting paid interest on your interest 12 times, not 4. Over time, that's a serious hedge. SCHD has become a crowded trade in dividend portfolios. Its upside is baked into the price, while the new ETF remains under the radar. Early adopters get the best entry points before demand surges. Don't wait until it becomes mainstream or the easy gains will be gone. SCHD's heavy allocation means good pricing power, but it leans into sectors benefiting from inflation, balancing with growth sectors. When prices rise, your companies don't just survive, they thrive. That's a key advantage in today's economy. As we consider macro trends like aging populations and rising costs, this ETF stands out by tapping into cash flow shifts more effectively than traditional funds. This ETF is conservative where it matters, but opportunistic where it counts, making it powerful for 2025 and beyond. Income is not just comfort, it's about freedom. For many, it's about building a sustainable portfolio that covers expenses. Imagine a $500,000 portfolio with a 6% yield. That's a potential $30,000 a year, moving you closer to financial independence. Many professional managers now use this ETF alongside SCHD, creating a hybrid portfolio for better returns and flexibility. By diversifying with this ETF, you can achieve smoother returns, fewer drawdowns, and a more adaptive income stream. When you're confident in your portfolio's cash flow, you're less likely to make emotional decisions. That means you stay invested through downturns, keep reinvesting your dividends, and your compounding continues uninterrupted. Investing smartly grows not just your money, it grows your discipline. The reason this ETF is turning heads isn't just the yield or performance, it's what it represents. Investors want smarter income, not just higher numbers. ETFs that can adjust, adapt, and thrive. If you want a pure, classic dividend growth play, SCHD's unbeatable. You're not just another investor. You want to understand where your money goes. You think long-term and value strategy. Do your research, check the prospectus, and understand how this ETF fits your broader goals. Don't follow hype, follow logic, data, and sustainability. If you found this helpful, like, subscribe, and comment your favorite dividend ETF. Keep your money working harder. Stay invested, and I'll see you in the next one. When you think about investing in dividend ETFs, most people get caught up in just one metric, the yield. They see a higher number and assume it's better. But that's not the full story. What really matters is how that yield is generated. Some ETFs juice their yield by using covered calls or high-risk bonds. Those strategies can limit your upside or even erode capital in volatile markets. The ETF we're talking about today doesn't fall into that trap. Its yield is built on genuine, repeatable business performance, companies that earn real profits, pay real cash flows, and maintain their payouts even during rough patches. In today's economy, interest rates, inflation, and supply chain issues mean informed action is needed. Smart diversification isn't just about risk management. You're owning a carefully filtered mix of dividend machines that can thrive across cycles. That's the strategy for resilience. We're not living in a normal economy anymore. Interest rates are up, inflation is unpredictable, and the supply chain is recalibrating. The next decade won't reward passive ignorance. It'll reward informed action. ETFs like this one show smart diversification isn't just risk management. You're not gambling on a single industry. You own a mix of dividend machines that can thrive across cycles. Investing shouldn't feel like a casino. It should be like owning a farm where you nurture and let time work. Historically, portfolios with a healthy dividend component have outperformed those focused on growth in risk-adjusted return. If you're planning for retirement or want steady cash flow in the next 5 to 10 years, that trade-off is golden. Imagine you've been investing $1,000 every month into this ETF for 5 years. You're earning a payout that covers real expenses. That's what I love about dividend investing. It connects directly to freedom you can feel. Stability builds momentum. When your portfolio gives you reliable income, you stop making emotional decisions. Why not design your portfolio to give you income as you grow it? You're accelerating your financial freedom. This ETF screens for quality, consistency, and payout sustainability. You're relying on rules that protect your income. If you found this breakdown useful, don't forget to hit that like button and subscribe for more.